much for organizing and inviting Fitch Solutions to present in front of a qualified and interested public audience. I will present the relation between news, liquidity, and spreads in credit markets. I will briefly introduce Fitch Solutions, its relation with RavenPack, and the common interest for the impact of news on credit markets. I will then present some literature existing on the subject. I will detach from it Fitch approach. I will present data, the proprietary RavenPack and Fitch Solution data which were used in the analysis. I will replicate some analysis that was done by Peter in white papers of RavenPack, and I will argue that in credit markets some deeper dynamic analysis is needed, and I will confirm the existence of relation among the three variables, and I will give tools for interpreting and analyzing such relations through time. I will then conclude and hope for feedback which will be useful in developing further products. Fitch Solutions is part of Fitch Group, of which Fitch Ratings is more known. And Fitch Solutions is a leading provider of a range of fixed income products. It focuses mainly on credit markets, but not only. And it distributes the ratings and the research of Fitch Ratings through a variety of platforms, and draws upon a wealth of expertise, skills, and market insight that I had the chance to enjoy in my 6 months with Fitch insofar, and that were fundamental in developing the results presented herein. The products are divided into three main groups, and the common interest with the RavenPack, which I don't think needs at this point any further presentation, resides in data analytics and in the exploit of the services which are distributed as Fitch Ratings research. Existing literature, as we saw today, is mainly on equity and forex return, and something has been done on debt on credit markets, and mainly in a paper by Bushman and others. You will find the detailed references already in these slides which are being made available. And the research from Professor Green, which is presenting today, was not available when we started this research, and will embed it in a white paper which is forthcoming following these slides, and will have many more details. The research from the academics is based mainly on the separation between different market participants, credit market participants, and being a more academic paper, it is based on the effects of private information, and the nice results that they found is that the dissemination of positive median content levels the competition between lender types. They introduced the concept of dissemination measured by the number of articles present in media using RavenPack data as a control variables. What we are focusing instead is on the impact of liquidity on CDS spreads, and after controlling for RavenPack data, our main goal is determine if and how liquidity impacts the credit markets, both in the short term and the long term, in determining, together with the news, the way in which markets express their opinion on credit worthiness of companies and of the whole sector as measured by the credit default spreads. The data are downloaded from RavenPack website. We use their proprietary ESS, Equity Sentiment Score. We filter out only insider trading and order imbalance, and we keep in all information also on equity, since for consistency we analyze the whole financial sector, but then we do some case studies and for many entities using only credit events was not significant. Data were sparse. So for consistency, the results that you will see on the whole sector keep in all the equity information as well as the credit events. We follow the practice of Peter's research in dividing between scores above 50 and below 50, and we keep out the news which have exactly a score of 50, and the ones above the cutoff are good news, the one below are bad news. We then define a new sentiment indicator as the ratio of good news to total news, so that we don't penalize for bad news, and our ratio goes between 0 and 1, and it is just the percentage of news over the most recent trading period, which are goods, so that it is not the good news surviving the bad news, as in some research of RavenPack, but it is just the percentage of good news. We then relate them to our proprietary liquidity scores, which are a part of the CDS liquidity score suite, and they are a rich measure of liquidity with respect to competitors, since they are based on the bid-ask spreads, on the spread dispersion, and also on the inactivity of an entity. And this allows to unveil more relations on the relations between the various between the variables. Our credit default spreads are part of Fitch Solutions CDS pricing service and use the Fitch proprietary corporate CDS index data, which filters out companies for which the liquidity is not high. It keeps in only the 75% most liquid single name components, and the rebalancing is done on a quarterly basis, so that the data that we use are only the more informative. The global financial industry in the most recent period, which ranges from 2007 to the beginning of 2013, is defined as the intersection of companies that are part of RavenPack service and of our CDS indexes, meaning that they are already controlled for liquidity. In this slide, we see some intuitive concordance through time, which is given by the red arrows, but also periods of discordance, which are relevant for all risk managers. And some bivariate analysis wouldn't be successful, wouldn't be enough to understand the relation between the variables. Looking instead at the liquidity and the spreads, again, wouldn't explain exactly what the relation is. There is some historical concordance at the beginning, which is given by the thicker arrows, but that may be a spurious correlation, since in that period the spreads were becoming more popular, so that the liquidity score was decreasing. A lower number for liquidity scores, mean a higher liquidity. This is common to all the analysis, and you will find the arrows guiding the interpretation. And in the same period, the crisis was starting to unfold, so one may be prompted to think that there was such a negative relation, which then comes back in some other periods. There are instead relevant periods in gray, in which there is a discordance with respect to this historical relation, and that needs to be understood. So it should be clear from just looking at data that a trivariate analysis is needed. In order to understand the relations, we replicated some of the analysis which was done by RavenPack on equity and forex markets, and we created the double sort analysis, in which the data are divided in cohorts or quartiles, in which the variables are grouped by liquidity and by sentiment score. and each entry is the average of the change of basis point of spreads. We put some color coding, meaning that red is strongly increasing CDS spreads, which is a riskier an indicator of increasing riskiness. And we couldn't find any clear specification, any clear relation among variables out of this static analysis. For some quantile, we can see relations, but not strong and not allowing to give a final interpretation, so that a dynamic analysis seemed more appropriate to relate the three variables. We replicated again some results given by RavenPack white papers, which is the Granger causality test, which is a test of significance of lead and lag relation, which may be interpreted in some fields as a causality relation, but it is just a relatedness, a statistical relatedness. And those tests all confirm strong relations between the three variables in different pairwise and different joint tests. The liquidity and spreads are always jointly caused by the two remaining variables in the systems, and in some case study, such as Wells Fargo, the news are not caused by any of the other variables, showing that in that case probably there is a smaller reliance of the company life on its CDS spreads, bearing in mind that we are keeping in all news, also equity news, so that we can understand the whole behavior of the news on the company. If we take instead another financial company, HSBC, the CDS market has a significant impact also on news sentiment. So that we think that in order to understand these different relations and different possibilities, we need a statistical model which can explain all of the dynamic relations and its statistical significance. So that we analyze each single series alone, and we see that no single series in the sum sample can be distinguished from a random walk. That is, we run different unit root tests, and we concluded that all variables are unit root, but some stationary and stable linear relation exist. That for the more mathematically inclined, this is the same of saying that the variables error correct, the variables co-integrate. And this allows to study both exogenous shocks to the system and endogenous relations. The existence of a stationary and stable linear relation allows to think that after a shock, the variables tend to repristinate, to set back the equilibrium. Statistically, the model needs to be identified, and we find that under normal identifying assumptions, the results on the qualitative behavior of variables repristinating the equilibrium are constant and can be thus exploited in forecasting and understanding the relations and the impact of shocks, mainly to news, with the variables thinking of going back to equilibrium. Then after some time a new shock will arrive, and assuming that the coefficients of the system remain constant, we can again explain the path towards equilibrium. The fact is that not only one single equilibrium exists, but due to the specific case, to the historical behavior of this series, more than one equilibrium can exist, so that we cannot give an exact quantitative explanation, the exact magnitude of the coefficients, but the qualitative behavior is always understood and can be interpreted. A tool which is common in the co-integration analysis and in error correction modeling is the impulse response function, which tells us what happens when there is a shock to one of the variables. It is relevant to see what happens to a shock in the sentiment indicator to news. If we see that in time equal to 0, there is a shock to news, and we track what happens in the system through time, through trading days, we see that there is a negative relation among of CDS spreads, so that the spreads decrease, being the shock assumed to be positive. So better news, sudden better news are propagated through the system with the decreasing spreads as expected. And this is robust to all the analysis, and this is not affected by the choice of the ordering with which the shocks propagates after it happens to the sentiment. That is, we can choose between having it propagated first to spreads and then to liquidity, or first to liquidity and then to spreads, since this remains unclear, but in all cases we see these charts, and in the incoming white paper there will be charts for both cases that convince that the ordering is not important for seeing the propagation through time. The analysis also allows to see what happens if one of the variables is kept constant, completely exogenous, and we see that initial values initial values matter in explaining what happens in the short run, since if we have in the top panel we have in the top panel we have high initial liquidity, for a value of 4.0 with respect to 11 is a high liquidity. Then we see that the CDS will tend to the long-term equilibrium that with these parameters values is around 160, by first increasing, overshooting, and then going towards equilibrium. If instead in the bottom panel we see a high initial liquidity score, which means low initial liquidity, then the reverse holds true, and the CDS spreads will go to equilibrium, towards equilibrium, with an initial overshooting towards lower value than what equilibrium allows. And that is a first explanation and a first evidence of the importance of liquidity. But as was said by Clara Vega today, there are feedback effects, there are endogenities in the variables, and this is partially seen in this in this slide, in which we see that if we leave the news in endogenous, then they are not constant to the initial values, but they are affected by the behavior of CDS spreads. These slides tells us that initial value of liquidity matters a lot in explaining the initial magnitude and the speed of convergence of CDS spreads towards a new equilibrium, and the CDS spreads bring together a change in the sentiment behavior initially. As expected, the sentiment indicator will follow its own path towards equilibrium in the long run, but in the short run it is led by the CDS spreads, which are in turn led by CDS liquidity, whose initial level is fundamental in explaining the speed towards equilibrium. This confirms the results of the Granger causality test performed at the beginning, in which in many cases the sentiment is caused by the joint behavior of other variables beyond leading the behavior of the variable itself. there is also some other some other dynamic analysis with the sentiment kept exogenous but changing, and we see some expected behavior of CDS spreads, which again change their path according to the initial level of liquidity. The conclusions, as pointed out, is that a risk manager cannot think of credit markets without putting together liquidity and news, and the understanding of liquidity remains vital in properly analyzing the market dynamics. Assessing volume information on CDS is challenging due to the opaque nature of this market, and the Fitch Solutions CDS liquidity scores can help risk managers identify names most likely to be impacted by changes in news sentiment by identifying relative liquidity of each CDS entity. We are currently exploring the viability of developing a fixed income indicator, a synthetic indicator based on these three variables, and any suggestion or request coming from practitioners would be very welcome. Any feedback or suggestion or request can be done to the author or to Diana, who is also in the audience and is available for networking. And let me remind that the report, the full report white paper of Fitch will be available soon on our websites or through email. The slides that you will be able to download from RavenPack website will have a complete reference for these slides. And I don't have much else to add to my presentations beyond thanking you for the attention and leaving some time for questions and answers. Clara, thank you.
How do you measure liquidity, the CDS liquidity?
The actual function is not released, but on our white papers, it is said that it depends on the bid and ask spread, but also on the inactivity, on the bid and ask spreads, on its historical variation, as probably many other competitors do, but also on the inactivity on the single entities, and that makes much richer information available to users.
So it's whether the mid-quote moves around or whether the bid-ask spreads are updated, I guess. Or
How many trades actually take place, and how much interest there is on the single entity.
You mentioned event sentiment.
Right.
Can you tell us a little bit more about what that means relative to a normal sentiment?
Yeah, it was chosen not to penalize for bad news. In Peter's research, the numerators is given by the number of good news, subtracted the number of bad news, so that it is an index of surviving good news. Whereas in this case, we found that it was more explanatory, the index based on good news only at the numerator, and then both indexes have total news at the denominator. Our index is between 0 and 1, faster to interpret. Yours can even be negative, but there isn't much qualitative, I would say, difference.
Okay, great. Thank you very much, Andrea.
Yeah, thank you.